Hey everyone, this is Finance Meets Real Estate. So we meet here every Tuesday, 6:30 p.m. Eastern time. I'm in New York myself. Our audience are finance professionals, analytical people, many of them, and like various real estate investors. So it's like pretty broad. We're on YouTube, Finance Meets Real Estate on YouTube. So we have lots of amazing guests every week. So this week we have Jeremy Goodrich. So he's a great speaker on commercial real estate risk and insurance. So he's going to talk about, so he's an owner of an insurance company called Shine Insurance, which focuses exclusively on commercial real estate. So they do different types of commercial real estate, multifamily, office, I believe retail, etc. And so he's going to talk about managing commercial real estate risk. And so, and in terms of like basically the way the biggest asset managers, operators, and property managers do that. And so, yeah, so without further ado, I'm going to pass it on to Jeremy. And if you guys have any questions, feel free to put them on the chat. We're going to open up for Q&A at the end. And yeah, Jeremy, go ahead.
Awesome. Thank you all so much for having me today. Pretty excited to tell you some stories. The bottom line that should come out of this conversation over the course of the next 45 minutes or so is basically a better understanding of what great commercial real estate investors do when it comes to decision-making and risk management. So those two things are deeply aligned. I think we'll talk about a lot of things that are just foundational to entrepreneurship, and foundational to commercial real estate investing. I'll talk a little bit about insurance as well, and just talk about the state of insurance and what we're seeing in the country right now. And then, of course, any comments or questions you have that you want to put in the chat, please go ahead and I'll keep an eye on that and answer those as well. So my name is Jeremy Goodrich. I'm the owner of Shine Insurance Agency. We take care of commercial real estate investors all over the country. Most of my clients have somewhere between 50 and 1,000 doors. I have clients that have all the way up to 5,000 doors as well, though. So we take care of a pretty broad swath of commercial real estate investors. I said doors, which obviously is a multifamily word, but I also work with hospitality. I work in industrial, retail, office, self-storage as well. So I work with a variety of asset classes in a variety of different markets all over the country. The thing that holds that all together, it is in the commercial real estate world. So I want to talk about risk for a little bit and dig in on some basic foundational things. The best investors have something in common. I work with hundreds of investors, so I just see a lot of different ways that investors deal with all sorts of decision making. And some of the commonalities of those folks that find success are as follows. They really find a team. And I know this gets stressed all the time in the commercial real estate world, but the folks who succeed really do this. They find a team, they put the right people in the right seats, and then they trust those people to find success for them. I think about Matt Faircloth, who talks about GP teams, and he really breaks GP teams down into 4 people, right? One is the hunter, the person who's going out and finding the deal, the boots on the ground, who's looking. This is, someone who's bringing deals to the team. The second is the underwriter, the person who's really putting the numbers together, making the business plan and making sure that this thing could work, or saying, you know what, this thing could never work. Let's move on to the next thing. The capital raiser, the person who's going out and finding that money, finding the lending, finding the debt, finding the investors, the syndication, however you're structuring it. And finally, the asset manager, the person who's making sure that the business plan was created, is followed through with from beginning to end, so that that property is profitable for everyone who invested. The thing I love about the way he broke that down into 4 people, of course, that could be 2 people, that could be 1 person, right? I like the way he broke it down, because what it says to me as someone who's thinking about it is, what role do I play? How am I going to sit in the right seat? Am I a capital raiser? Am I a good talker? Am I someone who can explain a deal to someone else and convince them to invest in that deal because I know it's really, really good? Or am I a numbers person? Do I just dig in that way, right? Or do I just want to go out and find deals? What I love about that is it helps you to make good decisions. And I think great entrepreneurs are constantly doing that. So when we're talking about risk management, what we're talking about is decision making at the highest level. Great investors make really good decisions. And over the course of this conversation, hopefully I'll be able to lay out what good decisions look like a little bit more clearly. So one of those ways you make good decisions is putting yourself in the right seat on your team. So as you're sitting there right now, wherever you're at, if you're just starting in commercial real estate and you don't have any money to really put in, well, it's probably time to really get to know your market, right? And dig in and be the person looking and finding deals. There's no better way to get in on a big time GP team than finding a decent 100, 200 unit apartment complex or retail space and bringing that to someone who does have the money, does have the team. Suddenly you've got 10% of a deal and you get a ton of experience, right? So that's the kinds of things that we're doing at the very beginning. I got excited about the roles and I dug in there, but I think that's the start of the decision-making process. So what is risk? I mean, risk happens all the time. You know, when I had a 4-year-old, he's 16 now, so it's whole different kinds of risk. But I tried to get him to eat broccoli, you know, and every time you put food on your younger kid's plate that you know they're not going to eat, you're taking a risk. You're pushing the boundary of something and you're asking them to do something you know they probably won't do. All of those things are risks, right? But you're doing it because you know the outcome has value and is going to be good for, in that case, your 4-year-old kid, right? And so you're pushing that thing. So risk starts with decision-making and starts with the things that you're doing. So how do we manage risk? So there's 3 types of risk. There's risk you can't control, you know, whether the Fed is going to increase a rate, what changes about interest rates from lenders, the political environment. So there's risks that you can't control. There's risks that you can control. Obviously, a lot on that list as well. But the third one is the most important one and the one that makes and breaks investors' journeys. The third one is risks you could have controlled had you known about them. Risks that were there, but because you didn't know about them, you couldn't take any steps to control them. And so they were left unmitigated. They became risks you couldn't control because you didn't know about them. So when we think about 3 different types of risk, we're really thinking about how we set things up and move forward. Got a little story. So my wife and I are very different in a lot of ways. One of them is how we plan. So we went on a vacation to Michigan recently. We went to Michigan City, went to like the coast of Lake Michigan. You can kind of see Chicago on the other side. It was nice. We enjoyed it. I started packing basically the night before we left. My wife, Mackenzie, as she does on all trips, started packing probably 2 weeks before we left on the trip. There was a table in our family room and it started having organized things on one side and, you know, some food items that she could put on the other side. The beach umbrellas and beach chairs were kind of sitting underneath the table. She was putting everything together and making sure that we had everything we needed. When I run out the door, I don't have 80% of the stuff I need. It happens every single time. I walk out the door to go do something and I come back in 3 or 4 or 5 different times because I forgot my wallet, I forgot my keys, I forgot my phone, and every single time I got to come back in. Mackenzie never forgets any of those things. Why does that have anything to do with what we're doing? Because she understands how to manage the risk of not having the things you need in a given situation. She's identified what she wants to bring. She understands how that's going to work into her process, and she manages the risk by making sure she has it. So she's really doing a good job of making sure that third piece of types of risks is as small as possible, right? There's things she can't control, what the traffic's going to be like on the way to Michigan. There's things that she can control, the things she knows. She's made sure we have a place to stay and all that kind of stuff. But she makes sure that the things she would have been able to control had she known about them are as limited as possible. Does that make sense? If you get that, maybe you can put a thumbs up in the chat or just say, get it, I got it. Yep. All right. Stefan says he's got it. That makes sense. 3 types of risk. Darwin, love it. You've got it. Okay. So the 3 types of risk, we've got what we can't control. We've got what we can control and what we would have been able to control had we known how to do it. So that gets us to the next step, which is what actions we have to take as commercial real estate investors to limit risk. Again, the best real estate investors out there take big risks. Now, you don't want to say it that way because your investors don't want to hear risk. No one wants to hear the word risk. But if you think about the decision to purchase a 240 unit complex in the north side of Houston, in the middle of a scenario where insurance is high, interest rates are rising, there's a lot going on, but I have a client who's doing that right now and is going to kill on that deal. I'm probably going to invest in it myself as an LP. Right? If for some of you who maybe haven't invested at all yet, or are new to the journey, or are financial advisors or what have you, the idea of buying a 240 unit complex that's already, got tenants in it and everything else sounds like a huge risk. And in fact, it would be a huge risk if you were doing that by yourself. In fact, I wouldn't suggest that, right? Why is it a huge risk for someone who's never done it before, but not a huge risk for my client who is going to kill with this deal? Well, they already have about 1,500 doors. They have properties all over the country. They're diversified in their markets. They have markets in probably 6 or 7 different places. They have property management teams in place. They have a team of GPs in place. They have capital raisers in place. They have asset managers in place. They have property managers in place. They have accountants and lawyers and an incredible insurance advisor, and everybody that they need in their situation. Not only do they have them in place, but they know how each of those members of the team work. That means they can make bigger decisions, take bigger risks, but the actual risk associated with that is really, really limited. When I talk about risk mitigation, it's not like, let's make sure we don't do anything that isn't safe. It's let's make sure the things that we're doing become safe because of the way we navigate them, because of the way we manage them. Question for you. Put in the chat, if you can, what market you're investing in. If there's a primary market you're investing in, I would love to see now where you all are investing. Where are the markets that you're interested in? I'm in Indiana. I'm in Bloomington, Indiana. So Indianapolis, Indiana is a great one. Scottsdale, Arizona, great place to invest. Louisville. Oh yeah, tons of, Mark, right on. Good to see you, Mark. Yeah, Louisville is a great market right now. A lot of clients in Louisville, a lot of clients growing in Louisville. Love that. Orlando, awesome market, very stable market. Pennsylvania, one of the cheapest insurance states in the country, right next to Illinois. Little known facts, Illinois, Pennsylvania, about as cheap as insurance gets anywhere. Boston, Mass, I love that. I wonder if it's condo investing. Donaldson, what are you investing in? I'm curious what's happening in Boston. I know a couple of developers in Boston that maybe I can connect you with. Awesome. So really all over the country. Nobody in the Southeast. Let's see, Dallas, Fort Worth, Phoenix. Dallas, Fort Worth is great. Awesome. So all over the country. Okay, so I hope that makes sense. We're building systems. That is the bottom line of what we're talking about today, is how are you building the systems that are going to help put you in the right seat and put other people in every other seat that you get connected with. The way that I create systems is to break things into smaller pieces. If I try and bite off all different chunks of a huge scenario, I just can't do it. But if I break things into different pieces, it really helps. Puerto Rico and South Florida, I got to come back to that. I've heard a couple of people investing in Puerto Rico. Very interesting. And South Florida, one of the most expensive insurance places in the world. Throw about $1,200, $1,300 a door if you're investing in multifamily into your penciling almost anywhere in South Florida. Florida is a whole insurance story in and of itself. All right. So how do we break up risk? Well, I've broken it into 4 quadrants, and I'm going to go into each in a second, just really, really quickly so that you can start to think about it. Risk is broken into 4 quadrants. Now, everything is financial risk. One of those quadrants you're thinking in your head right now, financial risk, because that's the first thing we think about when we're risking. When you have someone who wants to invest in your deal, hey, I've got $100,000. Tell me about your deal. You're going to start talking about the market. You're going to start talking about the property. You're going to start talking about the team. And one of the questions that investor is going to say is, how are you going to make sure my money doesn't get lost? I want to know that you're going to make me money. You're going to 2x my money over the course of 5 years or whatever your deal looks like. But what I want to know more than that is the $100,000 that I'm putting in is going to at least come back to me at the end, right? That's the basic principle of investing, is don't lose what you already have. Financial loss is what risk mitigation is about. Every single quadrant in this scenario is about finances. So you won't see a financial quadrant because it's all about finances. So the first quadrant is physical risk, right? So this includes buildings, this includes property, and this includes physical injuries. That could be injuries to employees, that could be injuries to tenants. I have so many claims that happen because of ice. The common example going on right now recently is a tenant's walking out, going to their car, January afternoon, slips and falls on ice, breaks an arm. That's a bummer, but not the biggest deal in the world. Goes to the hospital, $5,000, whatever that is, calls a personal injury attorney, and now, you know, they're trying to get $60,000, $70,000 from the insurance company, right? So that's a small thing that turns into a big thing. Obviously, there's much bigger potential injury risk. I'm not really like a big fear, scare you type of person. So I'm not going to tell sort of the worst stories, but there are tough stories out there, you know, that investors have had to navigate. And I'll tell you, the number one thing an investor says when they call me at 2 a.m. and describes some a fire that happened or whatever, is, I'm so glad I had X, Y, Z in place. The first thing that you're going to think when you experience something bad happening at your property is, did I do everything right? Did I set up everything right? Is this something I could have avoided? And if the answer is no, there's so much more peace of mind about that situation. There's so much more, okay, well, this stinks. We're going to walk through it, but at least it wasn't my fault, right? Risk management is about peace of mind. It's about making sure that things weren't your fault. Idaho, Montana, going back to the comments there, Katie, that's not very many in the Northwest out there. So good for you. So we're trying to make sure that things weren't your fault. So how do we do that? Well, first is physical, buildings, property, injuries. That's the first quadrant of risk. The second quadrant is relationships. So this is relationships with your team, relationships with your tenants, and relationships with your service providers. Relationships, for the most part, are navigated the same way across the board. They're navigated with contracts. We are in business with one another. We're in business with our GP team. We're in business with our tenants. We're in business with our service providers. And so every single one of those business relationships needs to be based on a contract. If you get into a GP team, make sure it's sort of like getting married, right? You're getting into maybe the biggest investment maybe you've done in your life, right? You're getting married to that person on a financial level. Make sure, and Brian, I'm forgetting his last name right now. Brian Adams talks about this of Excelsior Capital. He talks about this really, really well. You really have to make sure that you have that prenup with your other GP partners. What's going to happen if one person wants to leave? How's that play out? What's going to happen if other folks in the GP team feel like someone isn't performing the duties they've agreed to? How does that play out? Every single relationship, the better contracts you have, the better the relationship goes, because you establish the relationship right from the beginning. You said, hey, if this happens, this is what's going to happen next. And so you don't have to wonder, which takes away the fear, which gives you the peace of mind. And it actually means that bad things happen less. I love that about good contracts. And maybe I'm just a risk nerd, but to me, A good contract set up well at the very beginning creates a ton of peace of mind and actually makes it less likely that bad things happen, right? That's the entire goal of the conversation around risk, is being able to make big decisions and having it less likely that bad things happen. Contracts do that. So the second part of the quadrants of risk is relationships. The third part is external. Remember, we talked at the beginning about the 3 types of risk: risk you can control, risk you can't control, and risks you could have controlled if you had known about them. External is a lot of these things that we cannot control. That's a quadrant in and of itself, right? We cannot control the markets changing. We cannot control taxes. We cannot control politics. There's a lot of things that we can't control, and so they go in the bucket of the external quadrant. And then I'm a total nerd. I love entrepreneurship. I love business. I love systems. I love standard operating procedures. And so the fourth quadrant is really for me, and that is systems. Business can be broken down into 3 simple parts: your marketing, your sales, and your delivery. This is true of almost any kind of business, and it's certainly true of commercial real estate, right? And so the better your systems are in place, the more limited your risk. If you've got a killer marketing system with a great lead magnet, teaching maybe you're trying to attract, let's say you're trying to attract physicians, you're a capital raiser, you're trying to attract physicians, right? People who would be able to invest as LPs in your deal. So what is your lead magnet? How is your website saying to a physician the first time they come here, this person is for me? This investment opportunity looks on the surface like it's just for me, and look, they have something they want to give me that adds value immediately to my capacity to understand what it would be like to invest with them, and all I have to give them is my email, right? And so then you get them into your sequence and you start to engage and build a relationship, and that's how you start to attract physicians. Maybe it's your story. Maybe you were a physician. You started to LP invest in a couple of deals. Suddenly you realize the value of having passive income and the growth of cash flow and equity, and you start telling that story in your email sequences and things of that nature. Such a powerful tool to be able to attract people to your deals if you're a capital raiser. What is that? It's a marketing system. You have a system down, you know how it works. Now you can hire people to help you, whether that's VAs or team members or whatever level you want to go to. You have a system for marketing, right? Sales is the same thing. Generally, sticking with capital raisers, because that's the example I'm using here, we're going to have a webinar. We're going to try and attract people to our webinar so that we can talk about the deal that we have in place. If we're a 503B, or I'm saying that wrong, then we're going to want to have a phone call to make sure that we establish that relationship and get that clock ticking on the time that we've known that person. All those kinds of things are your sales process. The better you have a system in place for that, the better things are. And then delivery. Boy, do I like the email I got yesterday. It was from an asset manager that I'm invested with. And the asset manager said, hey, as you know, we closed on 12/31. And we said there wouldn't be any distributions in the first 2 quarters, but we were hoping, there wouldn't be any distributions in the first quarter. We were hoping to be able to do a distribution in Q2. It would really have a lot to do with how well we were able to stabilize the property. Good news is we have done better than we thought we would, about 5 or 6% better than we thought we would. There's going to be a distribution. That distribution will come on given date. Look out for that in your checking account. That's part of your delivery system. That's a really great example of the thing that all your investors want to see. Everybody wants to see that email, right? But that's because of the delivery system behind there. So the quadrants of risk are physical, relationships, external, and systems. I'd like you to put in this in the chat, of those 4, physical, relationships, external, or systems, which one is the one, as I was describing them, you were like, oh, I need to focus on this one? Is it like I need to focus on the buildings and the property and the things that are there, or you really want to focus on contracts? Maybe you're realizing that, you know, you don't have as many contracts as in place. I don't know exactly how you focus on external. I guess really understanding the external. And then finally systems. Anybody want to hop in there? Cedric, systems. I love that. Systems is one of my favorite part. Relationships with co-GPs, David, I love that. Absolutely. The biggest question is, how are you setting up those relationships in your contracts? You know, having lawyers on retainer is expensive. But it is, if you have the right lawyer who understands real estate law and understands how real estate works, it's absolutely worth every penny you pay to make sure your contracts are right and everything is good. Nelson's going to take a risk here. He says external. I love that. COVID, pandemic, or war, recession, right? And the thing you can control about external is whether you get involved in the first place. If you identify and understand the external risks associated with a deal, you can decide whether you're interested in navigating those things, right? If you see a deal, everything looks good, but it's in a small tertiary town and, you know, 80% of the employment in the area is a military base, that's an external thing that you can't control, but you do have control over to whether you invest in that city or not, in that town or not. At the very beginning, right? You have control over your decision making on the front end. So if you feel like, you know, that's a core, we have one of the 3 largest naval bases in the world. The 3 largest US naval bases in the world is 20 miles away from me in central Indiana. Now, I'm no genius, but I believe the Navy has to do with water. And I can guarantee you that there is no water anywhere close to me, and definitely not anywhere close to the 3rd largest naval base in the world. So why in the world would they have that? And it really has to do with the fact that it's the safest place in the country if we were to be attacked, right? Of course, the Navy has all their stuff on the oceans and all over the world, but their battery, and I don't know exactly what all they keep here, probably like, I don't know, a lot of stuff, right? It's all here and it would be very hard to attack. And so they've chosen to keep it safe for that reason. No idea why I brought up that example. Oh, you know, but I guess it makes sense in what we're talking about there. So let me just take a quick break here. I've been talking for a half an hour. And are there questions that folks have? If you just want to turn on your microphone, you could ask about risk. If you want to ask about insurance, I'm happy. If you want to ask about entrepreneurship or LP investing, let's see if folks have questions here before I go on any further.
So Jeremy, so just one question actually that was on the chat. Do you happen to have like a visual for the either like the 4 quadrants or like the 3 types of risk that you mentioned? I feel like it's really good for people to relate.
Absolutely. So I can, it's, if you go to LinkedIn, you can see a lot of the visuals that I've created. I didn't create like a one presentation for this, but a lot of these visuals are there. And I will absolutely, well, it's all there. So you can definitely find that. And I can put the presentation together and put that out as well. Okay. How can I become an LP? That is a great question. Let's see. All right, David, it's good to see you. Sounds like you got a seminar at 7. Have a good one. Katie, how can I become an LP? That's a great question. So there's a couple of ways to do this. The most common way, in general, large commercial real estate deals have minimums that are pretty high, like a $50,000 starting point. Now, there's a lot of diversity that's coming into how people invest in deals. I think we'll probably see NFTs taking on a bigger role, which probably will be smaller investments. I invest in Fundrise, which is just an app. I don't have a bunch of money in there. I think I have $1,000, $2,000 in there or something. But you can put as little as $100 in. But when you're wanting to get into commercial real estate deals, you either have to be an accredited investor, which means, I'm not the expert on this, but I believe it means you have at least $1 million in assets, or you make at least $200,000 as an individual or $300,000 as a couple. And then there's a new kind of element, which is called a sophisticated investor. And that's when you can show that even though you don't have those things, you don't have over $1 million in assets, or you don't have the annual income, you're very knowledgeable about real estate. And so you can become an accredited investor. And what's nice about being an accredited investor is you're open to more deals. This is where it gets into tax code. People who are advertising stuff out on social media, only accredited investors can invest in those deals. There are deals for folks who are not accredited. The weird part of that is people are not allowed to advertise it. So it's a lot harder to go out and find those deals. But the way you do that is really go to social media, go to LinkedIn, watch for commercial real estate investors that are talking about their deals, that are talking about what they're up to. Go to their website, download their lead magnet or connect with them, and start finding the investors that work for you. What's important is that you underwrite deals, and I'm sure there's been people on here that can talk more intelligently than I would about underwriting deals. Brian Burke's book, The Hands-Off Investor, is a great book for LP investors on how to underwrite deals and how to think about things. But that really is the terrible description of how to become an LP investor that probably could have been done much better by many other people in this room right now. Any other questions? Yeah, substantive pre-existing relationship with the sponsor. So you have to engage with a sponsor and then have, usually it's like what, a 30-day relationship, maybe it's a couple of months relationship with the sponsor. Yeah, there's a whole process of getting involved. Get that Brian Burke book, Hands-Off Investor, dig in there. And I would suggest starting to connect on LinkedIn and just watching people talk about this stuff. Look at the hashtag CRE, or right now, look up Yona Weiss, friend Yona Weiss, and any of the 20,000 plus people who Yona Weiss knows, and that'll get you started. All right.
Yeah, Jeremy, this is Nelson. Can you hear me okay?
Yes.
Okay, great. Jeremy, very good talk, and definitely slides would help, especially if you're a visual person like I am. You mentioned lead magnet, that's the marketing. Delivery, do we live up to what we promised? That's how I look at it. Do we live up to what we promised? And then as far as sales, how would you describe sales? You have a nice little description there.
To me, sales starts when you're one-on-one with someone, and it ends when they agree to be a part of whatever journey you're taking people on. So sales, even if you were, if someone reaches out and wants to have that first call with you, now you've crossed over from marketing into sales. Marketing is LinkedIn posts. It's like what I'm doing right now, coming on here and talking to you all. This would be part of marketing, right? There's no individual relationship going on. But Nelson, if you reached out to me afterwards and said, hey, I'd love to get on a call, let's chat a little bit. In my mind, that's where we've crossed. We've left the marketing world and we've entered the sales world, because now we're having a one-on-one conversation. So that would be the line. That's where I set the line. I think it's probably arbitrary.
Okay. And then when you're going into systems, systems to me is my Achilles heel. Relationships, I think I'm pretty decent at that. But then how do you break down systems? You get on the big whiteboard, or how do you go about doing that?
So I'm a systems nerd. So I have a team of 8 that's growing, and I don't like teaching people how to do things over and over again. I was an elementary school teacher for 13 years, so I am good at teaching. But I don't like doing things over and over again. So what I've built is a workflows and standard operating procedures. And I would suggest the number one thing you can do right now, if you haven't done it already, especially if you're a solopreneur, is start to write down step by step what you do. So the way I've done it is I first broke it into marketing, sales, and delivery, like I talked about already. And then in each of those 3 areas, I break them down into workflows. So in sales, I have a prospect workflow and what I call a binding workflow. One is when I'm talking with someone and sending them a quote for insurance. And the binding workflow is when they've said, hey, I'd like to get the insurance. What do we do next? So one is talking about the quote, the next one. And then for delivery, I've got, I don't want to get an insurance nerd or risk nerdy stuff, but I've got all my steps. So you've got marketing, sales, and delivery. And then inside of each of those, just sit down one day and think, how many different elements are there to each? Maybe there's 4 elements of marketing, 3 elements of sales. Usually delivery has the most, right? It has 5 or 6 elements, the different things you're doing as a part of your delivery. I really do need a visual. I'm realizing this right now, especially in this question, although I didn't know this question was going to get asked. But so you've got those things broken down. And then the last thing I do is break each of those things into phases. And every single process has 3 phases. And it's really simple. Phase 1 is collecting information. Phase 2 is doing the thing, whatever the thing is. And phase 3 is making sure the thing got done properly. So that's kind of almost a whole nother conversation. But the bottom line of how I'm answering your question is you've got to break down bigger things into smaller things. When I taught 3rd graders math, I didn't just teach them math. One day we would do multiplication, one day we would do division, and one day I would teach them how to start a business, and those are all different elements of what we're up to.
Okay. Jeremy, thank you.
So any other questions? And then Stefan, I'd love to know kind of what your timing is, what you'd like me to do from here, when you'd like me to end.
Yeah, it's really up to you, Jeremy. We usually go up to like 7:30, so about an hour. We have a question, just 1 second that I missed. We have a question. So what, in your opinion, is going to change in commercial real estate occupancies as it relates to post-COVID work environment preferences?
That's a great question. So the first place I think is obviously office, right? Office is the asset class most affected by where we're at right now. And I kind of see mixed results from my office clients. I mean, there's some folks who have large buildings are struggling to keep people in. Now, most of those had leases that were solid 5-year leases. Depending on the scenario, businesses, a lot of them have come back to 70, 80% capacity, but many are at like a 50% capacity and plan to stay there. And so, the post-COVID thing really has to do with office. And I don't think we're really into a place of true clarity right now of where that's going, because we're still in that flex place where everyone's realizing that they like to work from home, or not everyone. A lot of people are realizing that they enjoy the flexibility of working from home. They've moved out of big cities and moved to the places they actually wanted to live because they could work from home. And that's working pretty well for a lot of businesses. It's working for my business. I have employees in 5 different states. And so it works really well. Office occupancy for my clients has not come to a really bad head necessarily for most of them, but most of that's because they still have incumbent leases that started in 2020. So it'll be interesting to see how things come out from there. As far as other occupancies, I mean, multifamily, I think is doing fairly well. We're seeing that in reports from different places. I think a lot of people are more and more willing to rent. We'll see that more as interest rates go up and buying continues to be tough for first-time home buyers. So I see good things for occupancy in multifamily. It's always dangerous to talk in these kind of generalities, though, because in actuality, what market are we talking about? What's the scenario in that market? What asset class are we talking about? It really does have to be a little bit more specific. I'm seeing some more questions here. Do you recommend getting a commercial real estate license for people just starting? Definitely out of my realm. I don't have a lot of knowledge about licensing around real estate. So I unfortunately can't answer that for you, Darwin. Great question. I see people go, I guess the only insight I have there is really of my asset manager clients, probably 70 or 80% of them are real estate licensed and have E&O insurance for their real estate side, even though they mostly just manage assets, because it's helpful to be licensed in a lot of purchasing situations. Nelson, thoughts on short-term rentals as we're going into a recession, especially South Florida, Puerto Rico? Again, I hesitate to give insight into a market that I'm not personally super knowledgeable on the short-term rental side. I don't do a ton of short-term rental relationships as far as our commercial real estate stuff. So I don't think my insight is going to be very valuable on that one, Nelson. Apologies for that. Still seeing a lot of buyers with the high interest rates. I think this is really good. What I'm seeing right now is a lot of commercial real estate deals getting squeezed in the middle of a commercial real estate deal. So as you all probably know, most commercial real estate deals take 4 months, take 5 months, take 6 months. You know, sometimes you'll get a deal done in 2 or 3 months, but most of the conversations that I'm closing deals on right now started in January, started in February, maybe started in March. And so the biggest thing I'm seeing is deals getting squeezed in the middle of the deal, right? The funds that they can take out at closing are getting squeezed. On top of that, insurance premiums are going up in a lot of places, particularly Texas. And so I'm seeing a lot of investors who penciled a deal 4 months ago really getting squeezed and having to make some pretty tough decisions at the time of closing. Now, a lot of these investors have diversified enough that they can still bring this into their mix. Maybe they have a fund, and so they're looking at multiple different things that have all been bought at different points. But yeah, I'm seeing a lot of people get squeezed. And I think I got a question in the podcast earlier today, which was I just blanked on it. Well, anyway, I don't remember what I was going to say there. Seeing high interest rates, numbers. Yeah, I lost it. Apologies for that. All right. Any more questions?
I have a question, Jeremy. So on your website, you speak of smart insurance when it comes to commercial real estate. So what do you mean by that? And so in terms of the 4 quadrants of risk that you referred to, is your company helping with any of the non-physical risks in that sense?
Absolutely, yeah. So when it comes to risk, there's a couple of ways to deal with it. One is to avoid it, like that property in the town that only had a military base. Maybe you decide to go for it, but a lot of investors would avoid it. There's an external risk that we can't control that could really kill our deal, right? But another way to deal with risk is to pass it on to someone else. And this is where insurance comes in, and this is where I can answer your question. So if we can take a risk, most of us can't, our pocketbook can't handle if one of our apartment complexes burns down. And it certainly couldn't handle it if someone passed away in that fire and sued us. So if we had to take that risk on ourselves, no one would invest in commercial real estate unless they were already a billionaire and already could navigate that situation. The reason we can navigate that risk, the reason we can invest in commercial real estate is because we can pass that risk on. And one of the primary vehicles to do that is through insurance. And so when you're contacting an insurance advisor, what you're really saying is, hey, I'd like to pass some of my risk on to you. Are you cool with that? An insurance advisor would say, yeah, actually, we're going to ask you some questions. We're going to make sure we understand exactly like who you are as an investor. We're going to make sure we understand the property. We're going to make sure the property isn't super risky, doesn't have a roof falling in, or doesn't have old wiring or old fuse boxes where someone could put a penny in there and start a fire just by trying to get around a fuse. We're going to make sure this property is not super risky for us, because what you're asking is for us to take on a risk for you. And we've got to decide what we'll do that for. We've also, by the way, got to decide what we're going to charge you for taking on that risk. And so that's what's actually happening when you're buying insurance, right? The insurance company is like, do I want to take on this risk? And then, you're saying, well, what are they going to charge me to take that risk on? And how much of the risk are they going to take on? And so absolutely, one of the quadrants of risk that I navigate the most is the physical quadrant of risk, right? Buildings and property. The most expensive part of insurance for real estate investors is the property coverage for if a tornado takes out a building or if a fire takes down the building, if we have to rebuild that building. The other part that's really, really important about insurance policies is that relationships piece. If someone is injured, if a team member is injured, do you have workers' compensation insurance? If a tenant is injured, do you have general liability insurance? If they hire a personal injury attorney, do you have coverage for that? So you can pass on risk from the physical side and from the relationship side to an insurance, an insurance policy, and you absolutely should. So I talk a lot on the website about quality insurance. Now, you want the best pricing for your insurance, but you have to make sure it's actually going to do what you think it's going to do. Sometimes I say about 80% of real estate investors have insurance policies that will fail them when they need them most. And the biggest reason for that is because they went out and they made 4 or 5 different brokers compete for their business. And then they picked the cheapest one. And they were like, well, I don't understand insurance enough to really know what the deal is here. And this one's the cheapest. This one makes my NOI looks the best. This one makes the pro forma work. And so I'm going to go with that one. The reason it's a mistake is because in the weeds behind the front number is what actually happens if bad things happen. And I'm happy to get into that. But I think that it's really important to know that just like anything else, you get what you pay for. Sort of. I mean, sometimes I have the best price for quality coverage. And so there's a balance going on there, but it's really important that you find an insurance advisor that you trust, that is able to explain things in a way that makes sense. If you get on a 10-minute phone call with an insurance advisor and you walk away feeling dumber than you were before you got on about insurance, that is the wrong person. It's, you have to be able to have things explained to you in a way that makes sense. So it's balancing that. And someone who gets commercial real estate, if you're working with someone who says, well, I do all kinds of business insurance, then they're just less likely to understand how things work for you. So the way you purchase insurance, it's all about passing on that risk, right? You're saying, hey, I can't pay for a $1.5 million building if it goes down. Will you do it? And we say, yeah, we'd be happy to. We're going to charge you $6,000 a year. Are we good with that? That's what's going on there. Does that make sense?
Yes, and I have another question. We have also a question on the chat, but I was curious. So in terms of, because I know you mentioned, let's say like Pennsylvania and Illinois, they have relatively low insurance costs, high level speak, right? And let's say South Florida, they're relatively high, but that changes over time, right? There's like a series of, even if we look at simply climate, there's like it's not just flooding, right? There's like a series of various climate risks that are out there, and they get modeled, and like climate models are extremely complex, right? I mean, it's very hard to understand. So what do you guys use in terms of data on climate risk, and in terms of how premiums are going to evolve or get forecasted into the future? If, let's say, Florida is more expensive than Pennsylvania now, fine. But what if it becomes 10 times more expensive or something like that?
And it is, I mean, so Texas is a great example of this topic that you're talking about. Texas right now is in the most insurance flux that we've seen in a while. The last time we saw flux like this was Florida in 07, 08. So what's going on in Texas right now? Well, Texas has hurricanes. Texas has the coast. Texas has some of the biggest hail in the country. We already knew all those things. That's been true for a long time. What changed was Winter Storm Uri, I think is how you say it, URI. In 2021, February of 2021, you all might remember, in Texas, there was a big freeze. They called it the big freeze. The power grid went out. There was this whole thing going on, right? And that freeze, especially with apartment complexes, the losses were in the billions of dollars. And it was kind of a last straw situation where insurance companies like Liberty Mutual, Nationwide, Travelers, State Auto, some of these big names that you've heard of that were insuring apartments and are still insuring apartments across the country, were insuring apartments in Texas. In fact, if you own apartments in Texas right now, you may have an insurance policy with one of those companies already. But after Uri, when they saw those losses, that was the straw that broke the camel's back. And all those companies have now started saying no to Texas. So you've got all these big companies just leaving Texas. Now, they left Florida a long time ago. They left Florida in 07, 08, like I said. But those companies are leaving Texas right now. And on top of that, the biggest property insurance program in Texas, it was called Strata, it's still called Strata, collapses. They run out of money, they lose their reinsurance, they collapse. And so everyone who was insured in Texas with Strata is now getting cancellations at their renewals. So you got the big companies leaving, you've got Strata collapsing. What happens? Well, it's a supply and demand. It's basic economics. You learned it in high school. The demand is really high and the supply is really low. So, there's properties we're seeing in Harris County right now, where Houston is, where 4 months ago, insurance was $800 a door. Now we're having a hard time getting a policy in place for $1,200, $1,300 a door. 4 months. Now, do I think it's going to stay that way? I don't. I sure hope it doesn't. But I think what we might see is Texas will be similar to Florida in that we get used to it. I mean, it's not the high insurance costs that are inherently the problem. Lots of people buy property in Florida. Florida insurance costs have been high forever. It's the changing, it's the variability. If I can underwrite $1,200 a door for insurance, well, that's crazy. But if it pencils, I've still got a deal, right? But if I underwrite $700 a door for insurance, and then I'm 2 weeks before closing and it's $1,300, whole different conversation, because I believe something on the front end that I don't believe now. And so I think that's an example of how insurance changes. That's a really extreme example that we haven't seen very often, except in Florida in 07 and 08. For most other places, there's a fair amount of stability. Yes, climate change is happening. Yes, we're seeing a lot more storms and a lot higher losses. In fact, in apartments, insurance companies have lost money for 16 quarters straight on apartments in particular. So we're seeing a lot of insurance companies not want to insure apartments as much. And so we're seeing prices go up. I don't know if that specifically answered your question, but I think that gives you a sense of the economics working behind the scenes to make pricing do what it's doing.
It does, yeah, thank you. And yeah, so there's a question on the chat. So in a high interest rate environment, does seller financing become more common in commercial real estate? If yes, how do you write that up in the contract to keep the offer attractive to the seller?
I think so. I think seller financing is a great way to do things. And I think that the great thing about seller financing is, they obviously save in some capital gains ways. You have your investors right up front. I think of Jennings Smith and Yaden Smith are two folks that are friends of mine and do an amazing job talking about seller financing. They came out of Tim Brotz's program. But I think seller. So I just talked last week with someone who wanted to sell their insurance agency. Different world, different market, different asset type, same conversation. And when I was sitting down with them and they were, the first thing that I was doing is trying to listen. What does this person need in this conversation? What is it that they want? What is the value of them, the seller? And of course, I'm also listening in the same conversation. What is the value for me, the buyer? And do those two things align? A particular deal didn't work out, but the seller was willing to finance in that scenario. I could have gone in at about $40K somewhere like that and been able to figure it out. So I think seller financing is a fabulous solution. Tim Brotz's program is one that I think does a really solid job. I've heard he's shifting a little bit on his seller finance perspectives. I haven't studied him enough to know what that shift is, but I think who was asking Scott, I think it's a great thing to dig into. And I think, as many tools as you have in your toolbox, as many arrows as you have in your quiver, the better. And I think seller financing is a great arrow in your quiver. I think I mixed metaphor. No, I didn't mix. Anyway. All right, Stefan, 3 minutes. What you got for me?
Any guys, any last questions? All right, go. I'm curious for what, still on the climate question coming back. I'm just curious if, I know there was a company before called 427 that got purchased by Moody's, that they were doing some of the climate kind of, they were even doing like property value adjustments based on in sort of forecasts, I think, in the future, based on you know, where they see climate going. So they would, let's say, discount perhaps Miami or something like that, maybe. But is that, I'm just curious, like, I rarely speak to like insurance people, right? In terms of like, I'm curious how that gets reflected, because it seems to me like you need to collect a lot of data to be able to, you know, write an insurance policy for $1 million or whatever, like the premium of 6,000, so, or 2,000 or something like that.
Yeah. So, you know, the way insurance works is actuaries, which I think is a very fascinating job, really are the ones who figure out the rate that they feel they need to charge to make enough money to pay out the claims. And so actuaries have worked off of lots of different things over the course of the years, but as data gets more accessible, particularly about climate change, I think actuaries really in the last 5-6 years have had to decide how to figure these things into their costs. And that's one of the reasons I think costs are rising, is they are figuring these higher levels of losses. We saw in 2021 over, I think it's $22 billion in weather-related losses in the United States in 2021. That was the highest year ever. And so, you know, that is going to be consistent. There's no other way to navigate that from the insurance perspective, but to, you know, have premium come in to balance those things going out. Generally, insurance companies don't make money on what's called underwriting, on premium that comes in. Insurance companies give assessment at the end of a year, and they say what their underwriting scenario was, what their loss ratio was compared to the premium coming in. And if they had a 93 or 94% loss ratio, which means 94% of the money that came in went back out, that's really, really good. A lot of insurance companies have 101, 102% loss ratios, which means they lost all the money that came in and 2% more, right? So we're always right on the edge. Well, you say, well, how does a business model work? Well, they have plenty of money. No one should feel sorry for insurance companies. They're investing their money in a variety of different ways. The way insurance companies, for the most part, make money is not off of premium, but off of investing that premium in things like real estate and things like stocks and other elements. Insurance companies are one of the biggest investors out there in a variety of different ways.
Got it. Yeah, and I think to your point, Jeremy, and I know we're running out of time, it almost seems like to the point that you made about the different types of risks, where there is the risk of, you know, risks you could have control had you known about them, right? It almost seems to me that inherently insurance premiums ought to be rising and rising over time in a sort of monotonous way, if you will, or like constantly rising, just for the simple reason that we get more sophisticated about finding out new risks. Is that something you've been seeing like in your years of practice, or no?
Well, I've definitely been seeing insurance premiums rising. The other thing comes back to that supply and demand piece. So people are doing these complex underwritings of weather-related events and climate change. And so they say, you know what, property is just too risky. I don't want to insure a huge retail space that has a ton of roof space because it's just so likely that we're going to have to replace that roof for millions of dollars. We're going to start saying no. And so a lot of companies, because of what you're describing, are saying, you know what, we're going to get out of property, or we're going to get out of certain kinds of property, multifamily being a common example. And so then you've got a limited supply of the companies that are willing, and then you see, obviously, the demand stays the same, and so you see pricing go up. Either way, unfortunately, I think you see pricing go up. At the same time, there's people out there that are like, well, I can undercut the other folks and get a share of the market and hope that it works out okay. The problem is they usually get killed on claims and then they collapse 3 years later. So there's a whole game that gets played in that world.
Got it. Okay, so that was really great, Jern. Thank you so much for sharing your time here today. What is the best way for people to reach to you?
So shineinsurance.com is great. There's a tool that I would love for you to use, particularly if you are a multifamily investor. It's at shineinsurance.com/ballpark. And it's simply, if you go there, you put the property address in, you answer 9 yes or no questions, and you'll get emailed a ballpark insurance number for that property. Really great for penciling deals and making sure that you have a reasonable number in your pro forma for a deal. I have that built out for multifamily. I don't have it built out for other asset classes, but that is shineinsurance.com/ballpark.
Yeah, that's great. Thank you so much. So yeah, and thanks to everyone for joining us here tonight. Have a good night.